2:30, we'll go ahead and get started here. Thank you everyone for coming today, both online and in person. Today's guest speaker for seminar is our very own Megan Caldwell. She's a double alum of AOS. She finished the undergraduate program in May of 2021 and then immediately transitioned into the professional master's program, completing that in the summer of 22. As part of the professional master's program, Megan had to do a summer internship, and she completed that working in a co-op with Carpenter, which is the company she's representing today. A little fun fact about Megan: she really loves creative writing outside of the AOS realm. And when she was here as a student, she was really looking for science communication and science writing internships and positions, and that just didn't quite work out. I guess fate just opened the door to reinsurance and catastrophe modeling instead. So that's what she's here to talk to us about today, and I'll go ahead and turn it over to you, Megan.
Yeah, thanks so much, Caitlin. So, like Caitlin said, I'm Megan Caldwell. I graduated. I'm alumni of the AOS program. I'm happy to be back. My topics today are going to be talking about just giving a broad introduction to the insurance world, the world of reinsurance, which if you don't know what that is, that's okay. I didn't either. And what catastrophe modeling is within the context of the insurance and finance world. Caitlin covered most of this, actually. So I did my undergraduate and graduate here at UW-Madison. I was in the professional master's program, specifically with a concentration in climate science, risk management, and communications. Afterwards, I completed a catastrophe modeling co-op with Carpenter when I moved out to Philadelphia for a little bit. And while there, they hired me on full-time into the North American Peril Advisory team, which is a little bit different than actually what catastrophe modeling is and what I'm actually talking about today. But this is probably a little bit more widely known than what my work is, which is just a lot of advisory work and looking into model documentation. So it's a little bit less exciting, I think, in some respects. Just this past year or so, I moved actually to the Chicago area. I now live in Chicago as opposed to Philadelphia, so I'm a little bit closer to home, a little bit closer to all of you, which has been really nice and a little bit of a nice little change. So just going over a quick agenda of what I'm going to be talking about. I'm going to be first starting out with talking about what reinsurance even is, because I certainly didn't know that when I was an undergraduate, and I certainly didn't know it as a graduate student. And then I'll be talking about what catastrophe modeling is, sort of going over the components of catastrophe models and the process of how we turn insurance data into sort of loss data, and then giving a kind of overview of what those results look like, and then maybe going, if we have time, a little just a brief overview of where I work and kind of the structure of what my company kind of looks like. So, I like starting this kind of topic with talking at first about what insurance is supposed to do, or at least the theory behind what insurance is. And I'll be keeping this a little bit interactive, so if I maybe pose some questions to you guys, just keep that in mind. That might be happening over the course of the talk. So insurance, at least in theory, and I'm saying this in theory because I know that's not how it actually works sometimes, works on the idea that paying into a larger pool and then that pool paying out when disasters happen is cheaper overall than everybody having to deal with disasters individually. So you pay insurance so that, say, like when your house burns down or a really large hailstorm comes through, you're able to get coverage through the insurance company as opposed to having to cover the entire thing yourself. And boy, that's not always how that works, but that's at least in theory how insurance works in theory. The problem with insurance, though, is that insurance stops working when everyone's house burns down at the same time, because that increases losses much beyond what an insurance company typically has in reserve in order to pay out those premiums, and thus you get into a situation in which payouts is much more than premiums, and you have a much higher risk of the insurance company going under, and then nobody getting paid. And so where reinsurance comes in is that reinsurance essentially is just insurance for insurance companies. It's another way of transferring risk. Essentially, in a primary insurer, or the insurer that you would go to, say, like insure your house or your car, they then turn around and go to a reinsurance company and help and buy reinsurance coverage in order to cover for many kinds of scenarios, but in this case, and more relevant to us in the atmospheric and oceanic sciences, trying to cover for very large catastrophes. So essentially here, so like people like you and me, we never have to deal with the reinsurers. We go to an insurance company and say, buy insurance policy for our house, for our car, and the insurance company, which is known as the primary or the ceding company, then goes to the reinsurers to help reinsure those policies and help spread out the risk a little bit more. There's other reasons why insurance companies purchase reinsurance, but the bulk of one is, in fact, typically for catastrophe losses. It looks kind of something like this. So you have the policyholder, which is you and me. You might go through an agent or a broker if something's really complicated, like say you own a business and you need things like liability insurance and property insurance and workers' compensation all at the same time. You might go through an agent, which is then how you get insurance yourself. Most insurance companies then turn over to a reinsurance brokerage, which is actually where I work. I don't work at a reinsurer or at a primary insurer. I work at a reinsurance brokerage in the analytics department, which is further complicates everything I know a little bit further. And then as brokers, we help place reinsurance because, as you might imagine, if you have an insurance company and you have hundreds of thousands of different policies that are all a little bit different, lots of different buildings and lots of different scenarios, that makes for a very, very complicated way to want to get coverage. And so the reinsurance brokers and brokerages help place that coverage with your various different kinds of reinsurers, which can be either alternative capital markets, which are very complicated, I'm not going to get into because that's not really the point of the talk today, with typical reinsurance companies, or through things called Lloyd's syndicates. If you've ever heard the term Lloyd's of London, it's sort of like a big marketplace where you can buy reinsurance. That's what it is if you've ever heard the term before. And yes, this little part at the bottom, yes, reinsurers can in fact buy reinsurance. They're called retrocessionaires. Yes, it kind of goes way deeper than anyone wants to. Don't worry about it for the sake of this talk. Like I said, insurance companies buy reinsurance for a number of different reasons. The biggest one that I'm talking about regards us as meteorologists is this part, balance sheet protection from catastrophic events. You kind of see it demonstrated down here, which we in the industry sort of look at losses as either attritional, which are those like individual, like a house burns down, hail and damages your roof, or like you get into a car crash, versus a catastrophe loss, which is one event causes multiple different losses at the same time. So something like a wildfire or a landfalling hurricane along the Gulf Coast. That's really the big reason why catastrophe modeling became a thing in the first place, and why a lot of insurance companies have invested so much time, effort, and money into trying to predict and price these really, really big catastrophic events, because obviously they're very expensive. And up until about 30, 40 years ago, wasn't even really in the realm of possibility, something that people thought could be priced. So, with that, I'm going to start turning it over to what catastrophe modeling is and kind of how it came to be. And then I'll be going into, after that, maybe a little bit of a pause just so people want to ask questions really quickly, or if not, we can just kind of keep on going. So what are catastrophe models in the first place? Catastrophe models are a tool that quantifies risk due to catastrophes such as severe thunderstorm, floods, wildfires, earthquakes, hurricanes, tornadoes. And more recently, there's also been a lot of attempts to try and quantify the risk for things like terrorist attacks and cybercrime even. So there actually have been models that have been developed, but obviously with that, the science there is quite a bit different than we have here in the natural sciences. These essentially are probabilistic models that combine exposure data with hazard, vulnerability, and financial modules to approximate how much loss a location may experience per year, or the expected loss to an overall portfolio at different sort of statistical thresholds. I'll be kind of showing those results later on, but we use this for a number of different reasons, whether that's looking at pricing for these kind of reinsurance treaties for people, for the insurance companies to sort of price that risk. We also look at it in terms of being able to actually write those policies in the first place. Like an insurance company, for example, may not want to write a lot of policies in an area that has a very high, say, risk of a hurricane coming through and blowing off the roof. So you might want to figure out using these models what the expected losses for are at certain distances from the coast, as an example. You also see a lot of this is done for regulation. Most insurance companies have to use catastrophe models, at least some ability to both either buy reinsurance or just fulfill regulatory requirements in the first place. And you can also use it for something called portfolio management, which is the fancy way of saying, do you want to grow into one area or maybe kind of recede from another area? Like where does the portfolio want to look like? It can also be used to see essentially if there's an outsized amount of risk in a certain location. So if, say, a tornado were to come through this area and you shift that tornado by 20 miles north or 20 miles east, how much stuff does it hit? That's kind of what a portfolio accumulation looks like. It's sort of like concentrations of risk. So catastrophe models really started taking off right around when Hurricane Andrew came through. Hurricane Andrew at the time was one of the largest insured losses in the United States, really only surpassed by Hurricane Katrina, which is still and maintains the largest insured loss in US history ever. Around Hurricane Andrew is about when we start to see the insurance industry really want to try and price catastrophic risk, and especially for quote-unquote black swan events, or just events that theoretically can happen but haven't happened. And trying to price that obviously is very difficult because if something's never happened before, how do you kind of engage with it? How do you even pretend to know what the risk could be for something like that? So we start to see models becoming more accepted towards the mid-1990s and into the early 2000s, where obviously something that we all know as scientists is that all models are wrong in their own ways. But all models are useful in their own ways too. And so we've kind of hit these days a sort of happy medium where the insurance world does not overly weight the effects of CAT models, but also doesn't discourage them either. There's a lot more collaboration, understanding from both the insurers, the vendors who make these models, and from the reinsurers that catastrophe models are not the end-all be-all. They can't obviously take into account every single possible thing that could go wrong in the world around us. They obviously don't account a lot as well for things like that are more human-oriented. Like, how do you try and price for the risk of, say, a supply chain failure? Or how do you try to price the risk for something we call demand surge, which essentially is the phenomenon where after a big storm has gone through an area and prices increase because of the increased need for labor and materials to rebuild. That's what demand surge is, essentially. So even though catastrophe models are a very accepted thing within the insurance industry, especially in property casualty world, they are not the end-all be-all. There's obviously a lot of other data that goes into how these pricings work, but I'll be talking at least a little bit about how we get to those numbers in the first place a little bit. And also when it comes to these models, we use two different kinds of models. Deterministic models are using modeling of a single discrete event. So that's sort of like looking at your historical retrospectives. So sort of like if Hurricane Katrina came through today, how much damage would it do these days? They are typically historical recreations or a single hypothesis analysis. One of the things we also do is like say, what would happen if Hurricane Katrina made landfall 30 miles to the east? What would it look like then? These events are typically assumed to happen without regard to probability. They are meant to be just sort of like historical analysis and retrospectives. They are not typically used in actual pricing. Probabilistic models, meanwhile, the catastrophe models that we use for pricing, are using a series of stimulated stochastic events. They are accounting for the probability of these events over time. They are not physics-based models. They have physics components in them, but they do not actually simulate the physics themselves. They're stochastic simulated events in order to both cut down on runtime, because obviously in the world of business and finance things move quickly and you don't want having a model running for a week to get you numbers. But also just because in a lot of these things it's about the balance between being able to model what we know and being able to parameterize what we know in order to improve efficiencies. So what does this actually kind of look like then? Before I go on, I just want to kind of pause here because I know that there's a lot of terms I just kind of threw out very, very quickly. If anyone has any questions they want to just throw out right now, I'm happy to answer them before we move on.
I have one, Megan. On one of your prior slides, you had 4 little leaves, and one of them was green. It was stability.
Yeah.
Is that sort of made up and outside the insurance industry in the sense that that's what you do to satisfy people who want to invest in your company in the long term? You try and make things stable, and so this is the realm of the economists and financiers.
Yeah, that's a little bit more.
Insurance.
It's more in the realm of the economists. Like I said, there's other reasons why people will purchase reinsurance. One of the reasons is that, so essentially there's different ways that reinsurance is structured, like there's different ways you can do it. One of the ways that you can purchase reinsurance, essentially an insurance company can say, I only want to lose, say, like every year, the most amount I want to pay out in losses is $100 million. Like for example, like I'm just making up a number. Mm-hmm. When insurance structure, a treaty can look like essentially is the reinsurer assumes all of the risk kind of above that threshold. So in the case that like say, like a Hurricane Katrina comes through, the insurance company only has to pay out that $100 million, and the reinsurance treaty covers everything kind of above that.
So they can offer a prospectus to investors that says, we'll never go beyond this.
Yes,
you know?
exactly.
Okay, I
yeah,
see.
that's kind of what it means by the smoothing of results. The
Okay.
smoothing essentially is trying to say to investors or to other financial folks that we will only have a maximum of X many losses, X number of loss every single year.
Okay, thanks.
Yeah, that's what that means. If everyone else are good, we can kind of just move on. That's perfectly fine. I'm just going to take a really quick sip of water while we kind of transition into what catastrophe modeling, what the components and the process actually looks like from a day-to-day perspective. So, essentially, when it comes to the actual modeling process, it all starts with the data that we get from the insurance companies. Now, this obviously can depend on the insurance company itself. If it's a small regional insurance company, you may only have a couple thousand locations that are underwritten, whereas really, really big accounts from say a State Farm or a Progressive can be millions of locations in some respects. So everything starts with the raw exposure data. And as we all know, any model is only as good as the data that you feed into it. And that's very true of these insurance models as well, which is why we have to clean and scrub it. There's only so much data that all these companies know. There's every chance that when an insurance company gets us the data, they may not know what a building is made out of. They may not know what a building, may not have the exact coordinates of a building. In that case, we might have to go in and make sure everything kind of looks good on that side. There's also cases where they just accidentally miscoded something, or they coded something with a code that does not exist. And you would think that an insurance company whose job it is to deal with data would have better data quality standards, and well, that is how do we say, something we would all love to see actually be true. But in the event that after we go through, we scrub the data, we make sure that it looks good, everything is going to run properly, we then send back something called our control totals, which is basically us going, hello, insurance company, we have 100,000 locations here. 4 of them did not have any location data whatsoever, and the rest of them we are going to say are good to go. And that's basically us just being able to say to insurance company, of the data that you sent us, here's what we can actually work with. And it also helps them make sure that we're using the right portfolio. We're not running their, for example, running their workers' compensation portfolio for some reason through a catastrophe model that's meant to model hurricane losses. It's happened before. People mix up data all the time. We then, afterwards, we take the data we import it into a CAT model geocoder, which essentially takes location data, address data, and attempts to turn it into a latitude-longitude point component. Because these models all run off of latitude-longitude locations as opposed to, using polygons for your location. And this actually matters a lot, because the exact location of where that latitude-longitude component is actually placed on the map can have really, really large effects. For as an example, it's pretty easy to say find the location of a single family house in a suburb. What if you have a farm? Where do you place that point on farm? Do you place it on the building on the farm? Do you place it in the middle of a field? Do you place it on the barn versus the actual home that somebody lives in? Geocoding can be really, really important for a lot of perils and a lot of hazards where that fineness really matters, especially for things like flood. Flood is a very high-resolution peril, as we call it, or a hazard, and where you place that point for the model can really change losses because of the terrain elevation. So if you put your point in the field versus on the house, that can really change what the actual model returns. Yes?
So why are you restricted to just having for one point for a location that might have multiple structures?
So that's actually a good point. It all depends on the policy itself. So the policy may only, say, cover one building out of 5. So in that case, you have to really discern which building are you actually putting the point on. Or for a really large farm, there may be, say, several different outer structures like barns or sheds that aren't necessarily considered like your main property, and so you have to kind of pick and choose where you really want that one spot to really be. So that can, and there are some policies in which multiple buildings might be covered. And in that case, you would have, say, like policy 746 A, B, C, D, etc. And that's a good situation. We may have multiple different points for one policy, but it really just depends policy to policy to policy.
Thank you.
Yeah, no problem. After you have everything geocoded and you have things at approximately where you hope it will be, and every geocoder obviously has its own limitations on exact fidelities, you then launch your analysis, which can, for a small company, can go for maybe a couple of hours, to very large multinational ones that cover the entire span of the continent of the United States can take days. After that, you take your output and you do any post-processing that's necessary and you review the analysis. It's pretty standard in terms of how a model works, but in actuality, that can be quite a bit more intensive, as you might imagine. So when it comes to model input, there's a lot of things that we have to take into account. So like I said, obviously when it comes to a model, you want to be able to know what the policy is. That's kind of your first unmistakable point. You want to know what policy it is, because if you can't type your results back to the policy level, it doesn't matter. From there, you also want things like street address, latitude, longitude, if available, state, city, zip codes, the country it belongs to. For financial information, the big thing that we want to know is something called coverage values. That's your limits, that's your deductibles. That is being able to say, for a given location, how much value of this location has actually been insured. We look at a lot of different things in this area, but coverage value is really the main one. It's kind of broken up into 4 different components, which is building, which is like, walls, windows, anything that is physically attached to the structure of a location is your building. You have contents, which is anything inside the building, so things like desks or tables or this projector, for an example. You have other. Other can encompass a lot of different things, but typically is things like outer structures, like sheds, fences, things that are not necessarily attached to the building, but may still be covered under the policy, depending on the different terms. And then time element, and your time element essentially refers to what we call loss of use, which is how long can you, if a structure is damaged, what is the value that is lost by you not being able to use the structure? So in the case of like a shop, for instance, your time element value is the coverage for not being able to work and make money at the location. You also want physical characteristics of a building, because as you might imagine, when you're trying to price the risk to an insured location or to a vehicle, you want to know what it's made of, what it's used for. Occupancy is what it's used for, whether that's like a commercial building versus a single-family home versus an apartment building, as an example. Square footage can really matter in certain circumstances. We want to know year built, if it's available. And the last little point down there, that's secondary modifiers. Secondary modifiers can be anything that is not needed right away or is not like a primary building characteristic, but still might be very useful for understanding certain characteristics of the building itself. So those are things like how high is the first floor compared to the terrain elevation, because that can be really relevant for flooding. You want to know how high the building is off the ground. Secondary modifiers can also include things like roof age, because the older your roof is, the less hardy it is to things like hail and wind damage. So secondary modifiers are not things that are not necessarily needed for us to be able to give and return really useful information, but they exist in a capacity for us to gain more information and be able to more accurately model what damage may look like to a structure. And we take all of this and we put it into the blender, and that blender has 3 components. And this is where I'm probably going to spend the most amount of time because I think it's the most interesting. So every catastrophe model has 3 modules, if you want to think of it that way. The hazard module, the vulnerability module, and the financial module. The hazard module is probably the thing that you as scientists are the most familiar with. The hazard module generates the pattern of physical disturbance from a specific event. So that's looking at hurricane or earthquake or tornado and hail. This is the module where you want to be able to model the science as best as you can with the parameterizations involved, so it doesn't take a week to run a single portfolio. This is where you want to have really good understanding of what the hazard physically is for any given point in space. That's why for this you really want to have a good understanding of where your location is, how far it is from any coastlines, how far it is from any large bodies of water, or just where it is in physical space. This is where we generate the stochastic event database. Stochastic meaning sort of randomly generated with respect to what is physically possible with the hazard in question. So for the hurricane peril, because the hurricane is it's our oldest models, it's our most robust understanding of how the hazard actually works. Essentially what this does is the hurricane event database has tens, if not hundreds, of these events that have been generated to match what we best understand could happen in an environment. So it would have Cat 1s, Cat 2s, Cat 3s, Cat 4s, Cat 5s, tropical storms, tropical depression strengths as well. And it will simulate those paths across any impacted states that we have information for. We then are able to sort of look at point by point by point and say for a given event and for a given location what we expect like the highest wind gusts to be in the case of a hurricane or a tornado event. Or for hail, it's like a diameter of hail. For earthquake, it's magnitude intensity. For flood, it's flood depth, essentially. And so this is where being able to process and really understand the science really comes into handy. It's also where we see a lot of parameterizations, obviously, because we can't run these models with all the physics intact. But we see a lot of really good research going into how best to really quantify that amount of risk within those specific locations. Then we go to the vulnerability module, which is an attempt to translate physical risk into damage. So the vulnerability module essentially is a set of relationships that defines how structural damage varies with exposure to differing levels of hazard, such as ground motion, wind speed, flood depths, et cetera, et cetera, et cetera. This is where we start involving not just meteorologists or seismologists in the case of earthquake, but we start involving engineers. A lot of the vulnerability module work comes from folks in, say, the U.S. Army Corps of Engineers, but also a lot of researchers who have done work to see just how much physical damage can be done with differing levels of physical risk. Some of the folks who do a lot of this research, I went out and visited their lab at one point. They are the Insurance Institute for Business and Home Safety, or the IBHS, and they do a lot of work where they will actually go in and they will build like model homes that are like to scale, or like model shops and stuff. And then they'll put them in a giant wind tunnel, and they'll turn on the wind tunnel and see how long it takes for asphalt shingles to fly off the roof. Or they will load up their homemade hail cannon. They make their own hail. They have a cannon. I shot the hail cannon. And they will shoot it at asphalt shingles, or at siding, or at solar panels. Or they will take fire and they will actually burn the structures down and see how long it takes for these things to burn down and cause damage. And all of this is in an attempt to try and figure out how fast things get destroyed, how much they get destroyed, and trying to quantify how much the building does get destroyed in these sort of events. That's why we want to know things like how much these things are worth, what they are made of, what they are used for, how old they are, how many stories they have, because all those things can really impact how much damage is done to a structure when an event occurs. Finally, the financial module is attempting to take those damage ratios and damage calculations and turn that into an actual loss estimate. So with all of those things in place, how much does all of that cost? And this is where you want to have all your limits, your deductibles, or actually your financial economic terms to be able to actually understand how that translates. And the next slide has kind of a very, very rough approximation of what that actually looks like from inside the CAT model. So we take an event in the event set. For each location that is impacted by that event set, you determine the peak wind gust. This is a hurricane demonstration. You determine the mean damage ratio, which kind of has that little vulnerability curve. It's on the other side of the presentation. You can kind of see that curve for various different types of construction materials. In this case, we're going off of wood frame house. And if we say that the peak wind speed is 130 miles per hour, then according to this damage curve, which has been calculated based on like those tests I was mentioning, or things developed by the U.S. Army Corps of Engineers, or a bunch of other engineering firms, like, you see that for a wood frame home at a peak wind speed of about 130 miles per hour, you expect a mean damage ratio of 50%, which means that for 130 mile per hour winds, you can assume that the average house is going to sustain about half its worth of value, essentially. Then you determine something called the ground-up loss. Ground-up loss is a fancy way of saying loss before any financial terms kick in. This is how much is lost before any insurance terms apply. And then you take that value of the house, in this case, our value of the house is $1 million. You multiply that by the mean damage ratio, which is $500,000, the expected damages, and then you apply things like your deductibles and your limits to actually figure out how much loss you would sustain for that one event. And then you repeat that step for every single event set within the module to get sort of your approximate loss for various different events, and then you weight those events in order to get sort of an approximation for what that loss looks like over an entire year. So it's a lot of components going all in each other, just trying to approximate how much loss is going to be at a given location over different event sets over time. Yeah?
In the event sets, are those all historical, or do people try to make any kind of adjustments for things like climate change and events in the future?
So we do have historical event sets for things like, if you want to say, like run Hurricane Katrina. But most of these are stochastic, much in the same way stochastic randomly generated events that are within physical and climatic understandings. That's done because, obviously, as we all know, you need more events than just exist within a historical data set. But pretty much every major model event, for like a hurricane model, for example, will have those historical events baked in, because obviously that's what we need to validate the stochastic event sets that are created, because there's no model on Earth to try to predict hurricanes that doesn't have something generated, because there's just not enough data in order to do so.
So the real kind of step where people with like our training could help would be in how do you generate those stochastic sets of
Yeah, exactly. Like that's where a lot of the meteorology comes in, is being able to use the best science available to make those stochastic data sets as accurate as we possibly can make them. So one of the things that we do, like especially like during, say, large event response, like when there's a hurricane, that's barreling, towards the United States, the vendors, because these models are typically made by third-party vendors, we typically license them. We do make some in-house, and many companies do make them in-house, but most of them license. What they'll do is they'll release something called similar stochastic events, which essentially is their way of saying, we've looked through our event catalog, and based on what we've seen, and based on the track that we see of the track intensity of this hurricane that's about to make landfall, here's like 5 to 7 that relatively approximate what we might see like in our data set that might be sort of comparable. And obviously, when it comes to these event sets, there's only so many events within that event set that may apply to, say, like a Cat 5 hurricane going straight through Tampa at a 45-degree angle from the Gulf Coast through Florida. And there's only so many events that you can put in an event data set before it just balloons and becomes way too costly to run. So a lot of the work is trying to go into both making realistic event databases that run at a realistic time frame, but also are representative of the best science that we have. Mm-hmm. Yeah, that's a good question though, thank you.
Yeah, thank you.
Yeah, go ahead, in the back.
Vulnerability curves, do companies ever care about like standard deviations from that? Or is it just like, just give us the mean and then whatever value that comes up with, that's good enough for us?
Yeah, so the question was about like, do those damage curves have standard deviations? The answer is yes, kind of. When we get results, and I'll be actually showing some results on the next page, there is some amount of standard deviation that is built into a lot of the results. When it comes to the curves themselves, they're a little bit more, what's on the curve is what you kind of get on the curve. So, but that is one of the places, obviously, where we see a lot of the uncertainty, is being able to actually translate physical hazard risk into physical damage, which has always been kind of a struggle, I think, with a lot of us in the meteorology community, is being able to say, oh, it's very easy for us to say, oh, there's going to be a hurricane going over this piece of land at peak wind speeds of 130 miles per hour. But what does that actually translate to on the ground? Does that result in roofs getting blown off? Does that result in slabs of foundations just being all that's left of a house? That's the part definitely where we see the most amount of, I'd say, a lot of uncertainty, is just being able to physically quantify what does that damage actually look like in a lot of the respects. So there is some standard deviation, but the short answer is that most companies just kind of want the dollar amount. Yes, back there.
Yeah, thanks. You mentioned use of distance from coast as a parameter. I'm just wondering, for certain things like tornadoes or hail, that wouldn't, I mean, the distance from a coastline wouldn't really have a direct impact on those types of damages, would it?
Yeah, no, not typically. Yeah, the question was essentially distance to coast not mattering as much for certain perils, and that's true. For things like tornado or hail, it doesn't matter as much. For wildfire, it doesn't matter as much. But for wildfire, you might want for say, distance to like forested land. Like for wildfire, your concern might not be how close you are to a body of water, but how close you are to something called the wildland-urban interface, which is essentially where, you know, lots of urban environments meets a forest environment, and that's sort of like in between where you see not full forest but not fully urban, and you see a very large, possibly something called conflagration, which is when houses start igniting other houses and starting igniting other houses. And the wildland-urban interface is some place where you might really want a distance to kind of metric for like a wildfire, model. All right, and then just to really quickly go over what the results might look like. So when we typically get results out of a catastrophe model, there's sort of two main things that we are looking at. We are looking at specifically something called an occurrence loss and an aggregate loss. Occurrence loss is essentially the probability of a single event and a single occurrence will exceed a certain threshold. So this is, your occurrence loss is your Hurricane Katrina, your Palisades and Eaton fires that happened in LA this past year. Those are those really big events where you see a lot of loss happening all at the same time. Aggregate loss, meanwhile, is exactly what it sounds like. It is the chance that two or more events pushes you over a certain threshold. And when we look at those kinds of thresholds that we're talking about, it's primarily going to be in terms of either exceedance probability, so it's like, you know, the 10% chance of this happening every year, or in return period years, so your 1 in 10 year, your 1 in 100 year, your 1 in 1,000 year. They're not technically interchangeable, but the industry sort of uses both the exceedance probability and the return period years in order to satisfy the needs of customers, some of whom may have a better understanding of statistical probability than others. Because sometimes you say that there's a 1 in 10 chance this this is a 1 in year storm, or a 10% chance it's happening every year, and people get confused. So we use both of those terms, not necessarily interchangeably, but they are related to each other. And you can see on these curves that for an insurance company, it can be very useful to know that the average chance of, you know, you going over $200 million in loss every year is at a 1% chance. These are the kind of figures that ultimately is what's getting spit out of these catastrophe models, is an approximation of how much loss you can expect at certain thresholds statistically. Obviously, these are not the end-all be-all. These don't always account for things like inflation or for other human terms, or even just anything that could happen within the models themselves. The models obviously can't perfectly mimic every single risk that can go into something. We see this a lot in things like earthquake. So for earthquake risk, one of the things that we have built into the models, but not modeled explicitly, is things like landslides and mudslides. Those are very hard to actually physically quantify within the models and aren't necessarily going to be priced out specifically themselves. Or for things like for a flood catastrophe model, we don't have things like the risk of a dam breaking. Because like if a dam breaks, how much is that going to cost? Well, that's not necessarily going to be priced in to every single model, but it's a risk that definitely exists. So when we are using these numbers to actually price reinsurance treaties, these are guidelines. These are not the end-all be-all. These can't factor into everything that we need them to. That's where we get people like actuaries who deal with lots of math and statistics and numbers and are paid a very good amount to know how to do those statistics and math. And we also have a little bit of discretion as well, just from industry experience and from other things such as like inflation or demand surge, or just supply chains failing because of a global pandemic that closes all the ports for an indefinite amount of time. You have to price those things in as well. This page also includes something called the average annual loss, which is the long-term average loss expected in any one year for the book of business, or the book of business just meaning sort of like a portfolio, and for the peril being modeled. So you might have the average annual loss for wildfire, for hurricane, for flood, for tornado and hail, and you might be able to combine all of those to get an average approximation of how much loss you can expect from catastrophes, not from those like small little attritional, your house burns down randomly. This is specifically in regards to catastrophe risk itself. A little fun fact about average annual loss, or AAL, it is an additive statistic. You can subdivide it based on state, by zip code, by looking just at, say, single-family homes, or just your commercial profile. So you can use AAL to really get some really interesting insights at the location level, and from just sort of breaking things down as minute as you really want to. AAL is additive. These curves, these are not additive. So you can play around with AAL. You can't play around with the occurrence loss and aggregate loss curves. Those require a lot more math than just being able to add them piece by piece by piece.
Wait, sorry, so the AAL is like kind of in it weighting by the probability? Is that, can you explain what the AAL is again?
Yeah, so the AAL, the average annual loss, is the long-term average loss expected in any one single year for your book, for your entire portfolio. Each individual location as well has an AAL, and you add up all of those within your single portfolio to get at the total for the entire book for a specific peril. So in this case, pretend this is hurricane.
Okay, so you
Yeah.
get that by like integrating over the other data.
Yeah, exactly. Like basically everything all the data we fed into the catastrophe model is how we get to that number.
I mean, these numbers that you have up here, right, you could calculate your AAL from them if you had them for every exceedance probability, is that right?
The exceedance probability is very specifically sort of, that's a little bit different, but yeah, essentially you use the AALs to then compute the occurrence loss and the aggregate loss for different statistical thresholds, yeah.
Okay, maybe I'll ask you later.
Yeah, no worries, absolutely.
There's actually two questions online. One seems like it could probably wait till the end, but this one, how is occurrence likelihood or return interval or things like that built into the stochastic models? For example, how do you determine how likely a Katrina-like hurricane could hit a particular spot?
So the events themselves are built at different strengths, essentially. So each event has a certain peak wind speed, essentially. Each of the events within the stochastic database are used to sort of represent the potential to happen, and then there is some weighting that goes into how likely that event is to occur. So that's kind of how you get that statistic in the end, is you have this entire event database, and then the model calculates the likelihood of that happening within a given year. Yeah, in the back.
So, just so I understand this correctly, when we're looking at the exceedance probability, that's not saying 10% chance of event happening within this time period. It's like 10% chance that if the event occurs, it will exceed whatever
Yes.
the coverage
Yeah.
amount that the company is looking for.
Yeah, that's correct. So the exceedance probability is very specifically looking at the, let me go back a slide. So yeah, the exceedance probability is the chance each year that a company will see something that exceeds that point. So it's not necessarily saying Can you repeat your question one more time so I get the exact wording?
Yeah, it's just that, that 10% is just if an event were to occur within this time period, and my original thought had that the time period is that returns period.
Yeah.
There's a 10% chance if it occurs, then we're going to exceed whatever our coverage amount is and we'll need the reinsurance.
Yeah, essentially, yeah. Essentially, that's what
You said something different.
Okay, sorry. So, we're trying to figure out how to explain this because statistics is complicated, as you might say. So, this is specifically saying that this is a 1% chance each year the company will see a single occurrence causing a loss of or greater than a certain amount. So, it's not actually going off of if an event occurs. It's saying there's a chance just in a given year that a single event will exceed this, not if an event occurs, it exceeds that.
Yeah, thank you.
Thank you. That's what I was trying to get to. So I'm sure obviously you're also thinking, like, what's the actual practical use of all this besides just, getting prices in order to get a treaty filled once every year. You can also use this for a lot of really interesting geospatial analysis as well. You see a lot of this in terms of being able to do real-time event response during large events. We can take all this insurance information, put it on a map, and actually be able to overlay the best tracks and best wind fields that we have in order to do essentially portfolio analysis. We're able to kind of just break down things by wind categories or by surge heights or by likelihood of a wildfire happening, and being able actually to take those data back to various different insurance companies and say, here's about how much of your property is at risk based on what we know of where your stuff is located and what our models have said.
What's TIV, total insured?
Total insured value. Yeah, that's what TIV stands for. Thank you for asking.
Mm-hmm.
You also see that in terms of portfolio management, which, like I said, is sort of like looking at how an insurance company may want to move or recede from a certain area. We can use this to look at stuff over a specific concentration and then go county by county or zip code by zip code and essentially kind of price out the various different risks that may or may not exist in certain areas, whether that's looking at higher risk for one peril versus another peril, looking to monitor exposure into certain areas or trying to pull away from certain areas, trying to evaluate how much accumulation is in an area. So if, say, you have a bunch of houses in a neighborhood, do you necessarily want to have, say, 30 to 100 houses within a 2-mile radius, or would you rather spread that out over a larger area so that, say, if a tornado comes through, you don't have every single house that you've insured get hit at the same time?
What's a negative total insured value?
A negative total insured value? Oh, I think this one in particular is a year-over-year portfolio comparison on this side. So this is looking to see how a portfolio has changed from one year to the next. So in that case, the negative indicates areas where policies are no longer being renewed, essentially. So you see that there's been retraction from a certain area and growth in others. And so when we look at all the sort of stuff you can do with all this data, it's really varied. We have a lot of different ways that we can use catastrophe modeling data. There's a lot of stuff that goes just beyond the actual numbers itself. It can be a really useful tool to kind of look at where things are spatially, how they're changing over time, and being able to really measure how much exposure there is to any given natural catastrophe peril that there is. So just to kind of close up my portion before I just open up to more questions. So I work at Guy Carpenter, which is a subsidiary of Marsh McLennan, and has 3 other sister companies, which are Marsh, Mercer, and Oliver Wyman, all of which handle many different things. I specifically work at Guy Carpenter, which is a reinsurance brokerage and is a subsidiary under Marsh McLennan. We have a lot of different clients in all countries all over the world, lots of colleagues working on lots of different problems and solvings. We have a very long history, and there's a lot of really cool opportunities, not just at Guy Carpenter, but within the insurance and reinsurance world in general. Like I said, a lot of these models are made by third-party vendors. These vendors often are the ones who making a lot of those really tough meteorological research and decisions. There's a lot of other there's work within the insurers, some of whom have their own catastrophe modeling operations, in brokerages like mine, which oftentimes do the analytics as well, and also at reinsurers themselves, places like Swiss Re or Hanover Re, where they have their own in-house view of how these models work within the greater economic context. My team specifically is the North America Peril Advisory team. I work a lot with things like event response, model evaluation, climate change analytics, and lots of different solutions that go outside of just the models themselves. We have a bunch of expertise within the team. I'm one of our analysts. We have a lot of people with a lot of really, really good experience, a lot of really, really strong, research backgrounds. And, you know, the industry itself is really, really robust, and there's a lot of really cool people that I work with on a day-to-day basis. So with that, that's kind of all I had for today. Happy to open up to some more questions. I thank you all for having me here, and it's been a pleasure being back at the AOS department. And yes, Kim Roberts went to AOS.
Oh, she did.
Yep, Kimberly Roberts, the head of our North America team, she went to AOS as well back in the day. All right, questions? I'll take it right here.
Two. First being for catastrophe that can occur multiple times within a short span, how do you account for that in terms of damage modeling? So
yeah, so that's really interesting. So there's so in the insurance world, there is something called there is such a thing as a legally defined event. So when you have, say like a like a train of supercell thunderstorms going through an area over the course of a week, there actually is a lot of discussion that has to happen internally when that happens, because whether that counts as one event versus multiple events changes something called the hours clause. The hours clause essentially is what happens when you're able to determine how much loss you can attribute to any one event. And so if a line supercell thunderstorms over the course of a week, if that's one event, then the amount of damage recoverable under a reinsurance treaty changes, as opposed to if that was maybe 3 different events. Because you have not just, essentially goes from one event over the span of a week to 3 events over the span of like 2 to 3 days.
And then my second question was, you noted that you could do real-time modeling of certain
Yes,
events.
we can.
I would imagine that being able to highlight vulnerable areas would be rather crucial for local government in preventing
Oh yeah,
unnecessary
absolutely.
risk. Is
Yeah.
this data being provided to local authorities?
It depends. A lot of state insurance companies oftentimes will have these models available to them as well to be able for this kind of modeling. I'm sure similar things exist. Most of the time when we're doing this kind of modeling, it is for our clients. We're a publicly held company that deals mostly with client data, so we wouldn't be able to necessarily use data that we don't have. But a lot of this information is stuff that can be replicated by local governments and by open data initiatives. And there's certainly ways of sort of tracking where we expect to see the highest amounts of damage and loss. And there's a lot of collaboration I know that exists, however, with those kind of events, especially with local governments who will buy insurance or buy risk management programs. There's lots of things that exist in that area too as well. Yes, in the back.
Yeah, this is just a general comment, but going back to your remarks about that fact that insurance companies do make mistakes,
Mm-hmm.
I can confirm from having worked in the insurance racket for many years that there is a high level of mistakes,
Mm-hmm.
stupidity, and incompetence, and so those things do occur, and that is something to be aware of.
Oh, absolutely, yeah. No, the insurance industry by no means is without its many mistakes, many flaws, and many ways of trying to undercut or underprice risk, or trying to, ultimately those are ethical concerns as opposed to explicitly modeling concerns. But obviously, the more data and the more data we have on hand, the better it is able to just attempt to head those off before they begin. but that's more of a human discussion, I think, than perhaps a data discussion. But I know what you mean, yeah.
Yeah, Megan, I don't know if Guy Carpenter has an agricultural book, but I would imagine that those companies that do across the country are going to have one of their worst years ever. And how are they going to argue to farmers that it's not weather related, which is probably what they bought insurance for, but it's related to something else? Trouble at the end of the year is related to something else. How's that going to play out?
So we do have an agricultural division. When it comes to things that are not weather related and are more to the political environment, that's obviously in terms of losses a very complicated discussion.
Yeah.
I think that probably would fall more under probably liability as opposed to property itself. I don't do a lot with liability insurance, obviously. I don't really know how workers' compensation works. I don't really know, how various liability insurance works. But if I had to guess, a lot of the agricultural insurance that we'll see for this year probably is going to be a lot of fighting and a lot of litigation to see what can be covered and what can't.
Okay, and sometimes this goes to the legal system, so is it
Yeah.
possible an argument could be made that there were unforced errors and that the liability lies in Washington, D.C. for some of these losses?
I'm not sure if I would be able to answer that question,
Okay.
but unfortunately, I definitely think there's going to be a lot of battles in the legal system,
Okay,
if
Thanks.
nothing else. Yeah,
thank you.
yeah.
Right, I was curious, kind of a related question, but in a different vein. If you're trying to do the modeling of risk, particularly looking ahead
Yeah.
because of, sort of a decadal time scale
Mhm.
or longer, the federal government's been a big investor in climate research
Yeah.
to help drive and come up with modeling scenarios for what the future climate's going to look like. Would that sort of pipeline of research and authoritative data cut off in terms of what could be used for projections? How does that impact the
Yeah.
insurance industry, and do they then
Yeah.
begin to develop their own models and their own work in
Yeah,
that space?
so much in the same way that academia, uses open source data for their research, we are very much the same. Almost all of the research that we do is based off of the National Weather Service and NOAA to some extent. For climate change looking views, I can definitely say very, very strongly that Guy Carpenter still, believes in climate change and has a lot of climate change products and views of risk that obviously are complicated by political climates and by current government and political environments. So I definitely, from the reinsurance perspective, there's a lot of interest in climate change products. There's, depending on the countries and states involved, there can be regulatory requirements for climate change views. And so with a lack of information coming out of the government and lack of resources being updated, that does throw a lot of problems into question, some of which may require alternative data sources that I know that a lot of folks are very rapidly trying to quantify at the moment. I don't have any strong answers, unfortunately, just because it's a very rapidly evolving situation, but that is something that we are concerned about, yes.
Thank you.
Yeah. I'll take you in the back first.
I'm sure you're aware that there's been a dramatic increase in the number of billion-dollar weather disasters across the
Yes.
country. Can cat modeling help to sort out how much of that is because of the weather changes themselves or vulnerability?
That's actually something that's really interesting. So the question was, can CAT models help sort out what is due to climate change versus vulnerability changes? And there's actually a lot of really interesting research about a lot of those billion-dollar events and how a lot of it in the modern day is due in part to how much we built out the environment as opposed to just the climate changing itself. We call it the bullseye effect, if anyone's ever heard that term before. Essentially, if you take a tornado, you run it through a random part of, let's say, Wisconsin 50 years ago, you run that same tornado through the same spot nowadays, we've just built out more of the environment into urban environment as opposed to just being farmland. So what might have been just a tornado that goes through mostly farmland and a couple of houses now goes through a fairly large metropolitan area. So we do actually see a lot of that in catastrophe modeling as well. We're able to kind of sort out, in some part, those events. I can probably take one more question, and I'll probably have to wrap it up from there. I'll take the one that was online.
Okay, do you have any experience or comments on the increase in drain tiling in agricultural fields and its impacts on flood frequency or severity?
So I actually do work a little bit in flood, and when it comes to flood as a peril itself, the biggest problem with flood is that it's a hazard that we humans help to create because the more surfaces that we pave over and transform, the more you risk water going in places where it hasn't before. I don't know if I can comment specifically on agricultural risk in specific, but I do know that the more areas that you change and that you turn from forested or from wetland areas into things that have value, that's going to inherently increase the amount of risk to an area. But I think that's probably all the time that we have for today. Thank you all so much for your questions. I'm happy to continue sessions otherwise, and thank you for having me here.